Welcome, everyone, to today's Explainer. I am so thrilled to have you here. Today, we're doing something a bit different. We're taking a really deep dive into a true holistic wealth checkup, and we're drawing straight from some absolutely fascinating insights in ET Wealth's July 2026 edition. You see, we aren't just talking about numbers on a screen today. We're talking about how your wealth actually intersects with your everyday life. We're going to cover everything from caring for the people who raised you to keeping the tax man happy, and finally, how to make smart, calculated move in a market that's always shifting. So, here is our roadmap for today's deep dive. We'll start with caring for aging parents, then navigate some tricky new tax rules, break down the IPO funding trap, and wrap up with macro trends in quality investing. Let's just jump right in. First up, a topic that hits close to home for a lot of us: caring for our aging parents and making sure they have protection and peace of mind. For so many professionals living far from home, managing elder care is, well, it's the ultimate balancing act. Take Arpita Buyani, for example. She lives in the UK while her parents are in Gurugram. When her 84-year-old mother was diagnosed with dementia, distance became a source of spiraling concern. Arpita realized she didn't just need a nurse, she needed a whole trusted ecosystem. And it's not just NRIs dealing with this. Take Sanjay Mehta in Mumbai. He was struggling to help his 90-year-old father who had mobility issues due to a larger frame. These are very real, very human challenges, and they are driving a massive boom in structured elder care services. So what do these companies actually do? Think of them as a sort of proxy child. These firms offer a really wide range of packages depending on your needs. For instance, Samarth Elder Care offers plans running from about 11,000 to 17,000 rupees a month, and that covers everything from emergency support all the way to helping pay bills. Then you have Emoha, which has tiered plans starting at roughly 3,000 and going up to over 19,000 rupees. Or if you want something more flexible, Apollo Home Care operates on an a la carte model, where you simply pay per service. Basically, they act as your eyes, ears, and hands when you can't be there. But here is the absolutely critical part, guys. You are trusting strangers with the people you love most. So before you sign on the dotted line, you absolutely must do your homework. Verify their business licenses. Demand to see police verification for their staff. Seriously, don't skip that. Also, if they're providing medical care, ensure the caregivers are officially certified. Listen, a basic attendant charging 1,000 rupees a day is not a trained nurse. Finally, make sure you understand their exact emergency protocols and set clear expectations for how often they'll communicate with you. All right, let's switch gears completely from protecting your family to protecting your income by navigating some major shifts in tax rules. Historically, the presumptive tax scheme was absolutely loved by freelancers and small businesses because of its simplicity. Under the old 1961 Act, you just declared a percentage of your turnover as income, but you could still claim deductions like ADC or set off certain losses. Pretty straightforward, right? Well, the new 2025 Act changes the game. It consolidates this into Section 58.4 and introduces a massive catch: a blanket ban on claiming any losses, allowances, or deductions against your presumptive income. Literally overnight, your taxable income could inadvertently shoot way up. Which naturally brings us to a burning question that's keeping a lot of small business owners awake at night right now. Is this new setup going to trigger a tax audit? The expectation of simplicity is suddenly crashing headfirst into a pretty harsh new reality. And honestly, there is a deep, deep irony in this new law. Small taxpayers, we're talking those making up to 3 crore rupees, now face potential audits if their actual margins fall below the government's deemed benchmarks. And get this, that applies even if they didn't consciously opt into the presumptive scheme in the first place. Meanwhile, a larger digitally compliant business pulling in up to 10 crore rupees, sitting completely outside this framework, they might actually face less scrutiny. So a well-intentioned simplification might just be creating a whole new layer of anxiety for the little guy. Okay, let's move on to our third topic: the market, and specifically the IPO funding trap. Hype versus reality. Right now, we're seeing massive hype around blockbuster IPOs. But I need you to listen to this staggering statistic: 41.3%. Out of the 288 mainboard IPOs listed between January 2023 and July 2026, over 41% are currently trading below their issue price. Let that sink in. Nearly half of the companies that hit the market with massive fanfare are now sitting on losses for their original investors. You definitely want to keep that in mind before you go borrowing money to chase a quick listing gain.
But if you are absolutely determined to borrow, let's break down the actual routes available. You've got loan against shares and loan against mutual funds. These are longer-term secured loans hovering around 9 to 10% interest for 3 to 5 years. But then you have dedicated IPO financing. This is a short-term sprint, usually just 7 to 45 days, with high interest rates soaring up to 14%. And here is the real kicker. That borrowed money is merely blocked in your account. It never even reaches your hands, but that interest meter, it is absolutely ticking from day one. And that ticking interest meter builds into what financial experts call the break-even trap. Let's walk through the math. Step 1, borrowing gives you a guaranteed fixed cost, let's say 12%. Step 2, if the IPO is wildly oversubscribed and you get 0 shares allotted, which, let's face it, is highly likely, you still have to pay the interest for the blocked period. Step 3, even if you do get lucky and get shares, the stock must jump significantly on listing day just to cover your financing and pledge fees. And finally, Step 4, if the listing is weak, you are hit with a double whammy. You take a capital loss, plus you owe the interest. Leverage in this space is incredibly unforgiving.
Let's zoom out now and look at the big picture. Time for trends and quality investing, the macro view. Looking at ET Wealth's 10-year trend map gives us a fascinating macroscopic view of how different sectors actually perform over a whole decade. Believe it or not, metals, despite being notoriously volatile, surprisingly remain the long-term leader here. But if we just take a snapshot of 2026 so far, pharma is shining exceptionally bright, while the IT sector is really crumbling. The takeaway? Sectors rotate. Betting everything you have on yesterday's winner can be a really costly mistake. So, how exactly do we navigate all these shifting valuations and sudden market corrections? Well, ET Wealth sat down with Nilesh Surana, the Chief Investment Officer of Mirai Asset Investment Managers, to get some answers. And he provides a highly authoritative, expert playbook for making sense of the current market environment we find ourselves in today. His entire philosophy can be distilled into one profound yet simple truth: quality investing works, provided you don't overpay. Surana points out that right now, because of recent foreign institutional investor selling, changing tariffs, and various global crises, a lot of genuinely high-quality businesses, especially in sectors like private banking, are suddenly available at very reasonable valuations. Your margin of safety has actually increased. But that begs the question, how do you actually define quality? Surana gives us 2 golden yardsticks to identify these stocks. First, the company's growth must be consistently higher than the nominal GDP. Second, they have to generate a high pre-tax return on capital, or ROE. And he reminds us of a really crucial lesson. Don't just immediately filter by large cap, mid cap, or small cap. Size isn't the first filter you should use. The fundamental choice of the business itself is what matters. Because at the end of the day, a bad business is a bad business, regardless of its market cap. I want to conclude today's explainer with a provocative thought, one inspired by Surana's rapid-fire interview. He was asked to name a movie title that best represents his portfolio, and he chose Chuck the India. So I want to ask you, is your portfolio a Chuck the India story? Is it built on backing India's broader growth as a well-diversified team effort? Or are you just relying on a few highly volatile star performers to carry the whole game? Reflect on that as you look at your own holistic wealth strategy. Thank you so much for joining me to unpack these insights today and keep striving for that perfect balance.